This is a post discussing how big banks can manipulate the market, and one of the techniques used is called the iceberg order. We're going to also be discussing how does this technique affect the crypto market also. A definition of the iceberg order from Investopedia is an iceberg order is a large single order that has been divided into smaller lots, usually through the use of trading programs that the purpose is to hide the actual order quantity. When large participants such as institutional investors needs to buy or sell large amounts of securities for their portfolios, they can divide the large orders into small parts so that the public sees only a small portion of the order at a time, just as the tip of the iceberg is the only visible portion of a huge mass of ice below the surface. By hiding its large size, the iceberg order reduces the price movements caused by substantial changes in the stock's supply and demand. So a bank is trying to find a location that they want to do business and to manipulate the price around that location to work the area so that they can hide movements of their transactions without moving and changing the price significantly. So you'll notice here this is a previous resistance level that had many attempts previous to break that resistance level, and price fell. So this could be where the Bank of London has $60 billion worth of pounds that it needs to sell. And they don't want to do it all at one time because it would make price fall quickly and they would have slippage problems. So they want to hide their selling orders in this market and manipulate buying and selling in order to accomplish that. You'll notice here as buying began, it rose and then had this pullback, and this could be a portion of the selling of the bank because it closed at the 38.2% fib, and this was lowering the price to draw in retracement traders to find buyers. So the buying market drove the price up to the resistance level. Now in the retail marketing world, we would see this as a possible retracement level of resistance, and we would, through past history, want to be able to make a short order. So the bank begins to do some selling, and these three candles, this area here, you cannot see anything else. The market only sees to the left of the cursor, and these three candles are a bearish candle pattern, and as a retail trader I would look at that and see this is an indication that there's going to be a bearish movement, and I decide to commit now to enter my money into the trade. And here, as the market continues to go down, you'll have other sellers, but the bank stops and buys some pricing to move it back up to the resistance level. And again, you'll see these three candles are showing that the bearish movement should be continuing and that this bullish breakout failed. And I would commit again some of my trading capital into the trade. These two short trades, stop losses, are above the resistance level, is what commonly will be done. We'll discuss what happens to this stop level. Now, the bank does some more buying because it knows these stop levels are in here, and it's going to induce buyers into the market as the market price starts hitting those and drives the price up. And in this area here, you'll see that the buyers are losing some momentum, and this bearish pullback is where the bank will be able to sell some of their order. But you'll notice that they may begin buying, the bank may begin buying again here to stop that bearish movement, because it closes above the resistance level. It also closes at the 61.8% golden fib. Here, as you see this bullish candle, that is going to entice the retracement traders to come into the market, and the price will continue up. One of the things that's happening as buyers buy this pair, the opposite of their buy is a sell. So the bank is filling that side of the market and selling here, and as price goes up, they're filling the sell side of the order. Here you'll see another breakout where some inexperienced retail traders, continuation trade, would probably enter the market. Here the bank begins to sell. They're selling it at a higher price now, and as price moves down, you'll start seeing that when I make a buy order here, I'm going to put my stop level either here, or I'll put it underneath this level, or I may even go down to this level. But there's several areas where I can put my stop loss from these bull trades or these bull trades. So I have stop losses down here. As anytime there's a buying pullback, the opposite side of that is sells, and these bullish trades have stop losses, and as the bank begins to sell, they're hitting these stop losses, which are filling some of their sell orders, because a stop loss for a buy is filled by a sell order. So you'll notice all along here, as you began to make bullish trades, the stop losses are being hit by the bank. And what happens is the bank will manipulate the market to show you candle patterns that entice you to commit your trading capital. We call that entry cheese, so that you're willing to either enter a short trade or enter a long trade. And so all of these short bearish traders will lose as the market moves up and their stop losses are hit. The bullish traders will lose their stop losses as the price is manipulated down to where the bank was initially wanting to do, sell the market. Hopefully this helps, and in the updates we'll show you how you would work your trades in following the bank's initial bearish bias in this portion of the market.